Why should you care about investment management fees? Well, a percent or two of your lifetime could cost you millions.
If you're going to pay yourself extra to beat an index, which is basically your job, all right? If you're active fund manager, you have to beat the index. So now you want to pay yourself extra for doing your job. I don't agree with that.
Do I want to make directors of an investment firm rich? Is that the role that my pension fund is supposed to make? Or do I rather want more of that money working for me?
If we look at the average, a lot of funds are, just to be clear, rubbish.
Some of those, the top few, are really good. The rest are probably rubbish. They need not exist, but here we are. Welcome back to another episode of the Enough Club, where today Pieter and I are going to talk about investment management fees. And why should you care about investment management fees? Well, a percent or two of your lifetime could cost you millions. And so today we're going to discuss a little bit about how to identify them, what your fees are, to quantify it. But to take us further now, Pieter, you can lead us into this conversation. Just unpack this a little bit for us. Where do people get to know more about their fees? Where can they find this information?
Thanks, Brian. It's such an important topic that I think so oftentimes we skip and we miss. And it's one of those things that you may not know about it right now, may not show an interest in it at this very moment, but it's the effect you'll feel in many decades to come. And with most things in life, if you only learn about it later on, you can't make up for lost time. So what we're trying to do in this series on investment fees is to bring awareness and clarity, just to understand kind of what are we paying, what is reasonable to pay, how to even determine what we pay, and then to have a conversation, an open and honest conversation to understand what we need to look out for to understand the value that we receive for the fees that we pay, because that equation always needs to add up. So to start off, when you want to look at your investment fees, there are a couple different components that we need to actually take a look at. And the best way to find like the most encompassing view of all the fees you pay on your investments is to request what is known as the effective annual cost, or the EAC breakdown. Now you can send an email to your investment provider, you can ask your financial advisor if you have one, and then that EAC will have 4 different layers of fees: the investment management fee, the advice fee, the admin fee, and then the other fee. In this series, we are going to cover all 4 of those different layers of fees. In this specific episode, we're going to focus on investment management fee, which is basically the fee that you pay the fund manager. So, when we invest in our money into a fund, there sits someone behind the fund that will manage the fund. Now, this could either be an active manager or a passively managed fund. So the investment management fee is the fee we actually pay for the fund that we invest in, and that fund will then be diversified across different types of asset classes, which we've covered in the previous series, like equities, bonds, cash, and other types of property potentially. So investment management fees is the main focus for today. And typically we get 2 types. We get the actively managed funds and we get the passively managed funds. The actively managed funds are the ones where there's a fund manager that sits behind the investment. They're usually very well qualified. And what they're trying to do is they're trying to beat the average market return. And in order to do so, they've got a bigger team, highly qualified professionals, which means that the costs for those funds are also higher. So we pay a higher fee for the potential upside to outperform the markets. And then we get the passively managed funds, which says, what we are going to do is we're going to cut costs down to a minimum. We use algorithms and computer programs to track an index. An index is basically like a collection of different shares and asset classes that tracks a specific portion of the market. And in doing so, we are going to get the average. So we keep the costs down and we are happy with the average. So now the big question comes, which one do we choose? So Brian, back to you. What do you think?
Yeah. So when it comes to costs for investments, you can potentially try to lump some funds into different categories and say, well, these are actively managed funds and these are passively managed funds. And so passively managed funds are generally lower cost. So like your ETFs and your rules-based investments. And so you might say, okay, well, that's going to be cheaper, and active funds are generally more expensive. And so you could say it's one versus the other. That's kind of a common thing we see people talk about. We see articles about it, active management versus passive. This isn't really a debate about that. I think that might come in a future episode. But for now, you just know that the one will be more expensive than the other. And so what we look at, when we look at investments for clients, we try to understand the costs, And then if you're getting value for money. So for example, let's just say you have your pension fund. And I mention pension fund because it's like some of the biggest pots of money in South Africa for investors are pension fund money. And so you get those balanced funds or managed funds, they're called. And so a lot of money will be in them. And you might look at the fee for that investment management, and it might be, say, 1.5% a year. That's quite a common fee for an actively managed multi-asset fund that your retirement funds are in. So multi-asset, multiple asset classes. So it's got equities, bonds, cash, and all of that. So 1.5% a year, you might say, okay, cool, doesn't sound like a lot. And so say your return is 10% a year, you paid 1.5% to get that 10% return. Now, what you might have is the passive version of that fund. So like another fund, a competitor, but instead of picking stocks around the world and in South Africa, 30 or 40 or 50 stocks only, when it's invested in South Africa, it's invested in the whole JSE. And when it's invested abroad, it's invested in all the indices like the S&P 500 and so on. And so that might come in at 0.5%. So the other one was 1.5%. This is 0.5%. Now you might look at the performance and say they both, for argument's sake, have given you 10% a year over the last 5 years. Then you can look at the fees, and this is where it becomes valuable, but you can do an analysis. You can compare apples with apples and say, look here, this fund produces this for me, maybe 10% a year, and it costs 1.5%. This other fund produces 10% a year, but it costs 0.5%. So you're paying 3 times more for the same outcome. Now that might be something you pick up from your analysis. Maybe you pick up the opposite situation. I doubt it, but maybe you do. And so now knowing what your investment fee is and a way to look at it, look for it, that kind of helps inform you and say, well, do I want to make directors of an investment firm rich? Is my job, job creation? is that the role that my pension fund is supposed to make? Or do I rather want more of that money working for me? In our firm, we generally look for efficiency. So we will look for the lower cost where possible, but lower cost isn't always the best way to go because it's actually about what that investment's meant to do for you. And so the investment fee, the investment management fee, is generally described as a TIC, so the total investment charge. Back in the day, it used to be called a TER, which is the total expense ratio. And then you add the transaction costs to that. So a TER plus a TC, transaction costs are like buying and selling shares, this brokerage. And so you add it together, you get what's called a TIC. So when you look at an investment fund fact sheet and you will see the TIC, maybe it's 1.5%, maybe it's 0.5%, then you know that is what that fund costs. Now, one important thing though, you might say, okay, fine, I got a 10% return according to this investment report. My TIC is, 1%. Now, did I actually get 9% returns? And that's not the case. The investment costs for the actual fund itself that you're invested in, or the ETF, those costs are deducted by the investment manager before they publish the returns. So in other words, if you got 10% a year return and the fund costs, 1%, you don't have to still deduct that 1%. The investment return has been published and is net of fees. So you can think of it as this way. This is how I think of it. I'm not the most intelligent guy, and so I've got to simplify things. And so if I think of an investment fund as this round like bubble, and your money is in there, and it's managed by XYZ Asset Management. So your money is in this bubble. And now before they give you your money back, in other words, before they give you a return, they keep what's theirs. They keep their fee. So the money goes out, and they say, you get 10%. They've kept their fee. And so just remember that. So if you get 20% a year return, but the fee is like 3% a year, and you say, well, that's a high fee. Well, if it gave you 20% every year, that's probably worth paying. You don't have to still take the 3% fee off of that return. Pieter, something that we know as advisors for our clients is that you do get the active and passive funds that are different in costs, and the difference can be quite mind-blowing. What is your experience as a South African investor with the ETF market and the kind of costs you can ballpark that you can kind of expect when you're investing in ETFs as a South African investor, not necessarily the UK or the US, where I think their costs on a whole different level.
Yeah, it's crazy to see how the differences come in. And to add to that point is when we compare ETFs on a local versus global scale, we need to take into account the size of the economy. Now, South Africa is actually very tiny compared to the rest of the world, make up about 1% of the world's market cap. So that means our markets are by default not so efficient. That means the fees that we pay are generally quite higher than what you will find in a country like the US or the UK. So in the ETFs, maybe just to explain the difference, because we also get unit trusts or index funds if it's a passive form, and then we get ETFs, exchange traded funds. So they are very similar. They're almost like brothers, but they're not twins. So the difference comes in if you buy a unit trust or an index fund, then it's generally like a manager that pulls your money together with other investors, and then they then go and buy the underlying funds with that collective money. And the price for those unit trusts will stay the same throughout the day. But with an ETF, it's almost traded like a share. So if you buy individual stocks, you'll buy your Apple or your Teslas, and you'll see during the day the cost will fluctuate. In the morning, it might be, I don't know, $100, and the afternoon it might be $105. That will fluctuate depending on the market's volume. Now, ETF also trades like that. So typically what I've seen is ETFs are usually cheaper on a fund level. So the TIC that you mentioned, the total investment charge, is generally cheaper with an ETF. But there is some word of caution with ETFs, because if you buy ETFs on a brokerage platform, and this is typically within the DIY space, if you compare the TIC, maybe of two funds that tracks the same index, maybe there's the MSCI World Index Fund and there's the MSCI World ETF. The TIC of the ETF will most likely be lower. But now what's important to understand is if you buy and sell ETFs, every time there's a buy and sell, there's a brokerage fee that you're going to pay the platform. And that is usually then cheaper if you buy and hold over the long term, because that once-off fee gets diluted by the time that you hold it. But if you're now going to buy and sell ETFs every second day because you've watched the news and now I want to buy into that country and I want to buy that index, then it's going to come very expensive. So within the TIC, you mentioned the TER, the total expense ratio, that is the fund manager. And then the TC, the transaction cost, that is usually what we refer to that brokerage cost and the bid-offer spreads. So it's important to understand with ETFs that they can get quite expensive if you are going to trade frequently. Now, our philosophy with most of investments and long-term investments is buy and hold. You do a lot of research, you do a lot of homework to choose the fund that you need to invest in to make sure that you reach your goals, and then you keep it. I mean, you can always add to it. That's good. That's what we want to do. But we're not in a business of buying and selling all the time, because then that's almost like hidden fee, because you don't always see that buy and sell fee on brokerage platforms. Yeah. So that is one thing that I think it's important to understand when we talk about ETFs. They are generally cheaper if you buy and hold. So just be careful on brokerage platforms. There's another fee that we often see on the fund fact sheets above the TER, and that's the management fee. And oftentimes get asked, is the management fee, should we add that to the TER and the TC, or, is that a separate fee? And that management fee is always included in the TER. So just take note of that as well. TER plus TC, we get the TIC, which is the investment management fee that we see on the effective annual cost. Now, there is one fee that I think I'd like you to expand a bit on, that we don't see so often anymore, but it has been quite a common fee in the past, the performance fee. So can you maybe tell us a bit about that and how that works?
Yeah. Okay, cool. So performance fees. Performance fees are relevant to active managers. So just to remind everybody out there, an active manager is someone that will pick specific shares. Maybe they run a global equity fund. So let's just call it, I don't know, Johnny's Global Equity Fund. And Johnny says, now, I think I can beat the All Country World Index. I'm really sure I can. And so what they're going to do is they're going to, instead of investing in the All Country World Index ETF, they're just going to create a portfolio, and it has between 20 to 30 shares in it. from all around the world. And so they pick those shares and they say, this is where we're going to invest. And then they come up with a benchmark. So they say, look here, if I beat a certain return benchmark, I can pay myself some of the profits. It's a performance fee. It's kind of like getting like I've exceeded your expectations or my own expectations. It's very cool, when you set your own benchmark and then you just beat it quite easily. But anyway, so that's controversial. So when you say, fine, okay, this is my benchmark. If I beat it, I get to keep some of those profits. So what they're trying to say is my intentions, my incentives are aligned with yours as the investor because we're trying to just grow this money as much as possible. Now, what they often pick is a benchmark that might be very tough to beat. Not normally, because they're in the business of making money. And so what they'll normally pick is either the median return or the average return for the category. So what do I mean by that? Now, there might be Johnny's global equity fund, and he's competing with, say, 100 other funds in this industry. Now, they're lumped together by the regulator in what's called a category. And so in that category, they'll take the average return or the median return of two different things. They might take the average or median return of that category, all those funds. And let's say all of those funds over the last 5 years or so, the average return is 8% a year. And Johnny was getting 10% a year on average. Then what happens is he might say, look here, there's a 2% return that I got over and above what the industry is giving you, the category is giving you. Then what they'll do is they say, I want a portion of that because I exceeded our expectations. I did really awesomely. And so that is where the performance fee comes in. And so if it's been a good year or a good few years, the TIC of the fund, the total investment charge, will increase because performance fees have been taken, profits have been taken, and so now they're paying themselves for being really good at their job. Well, the problem I have with this to a large degree is that they set their own hurdle. They set their own benchmark. So if I, for example, was going to try and run a fund, an equity fund, which I won't, and I wanted to make sure I could get paid profits often, I would probably make sure I could get paid profits often. So I would make sure the benchmark is super low. Yeah. So if the hurdle that I have to jump over, that I have to clear is super low, there's like a good chance of success. And the best way to do that is to say, let's beat the average of our competitors. Because there are some very good funds out there, but there are many rubbish ones. That's the bottom line. South African investors, I think the world over, but I can only speak for South Africa, there are maybe 100 or 200 funds in a category that you can invest in, any given category. Some of those, the top few, are really good. The rest are probably rubbish. They need not exist, but here we are. And so now if you say the average of these rubbish funds is my hurdle, it's not really great. What they should do, and Pieter, I don't know if you agree with this, is what they should say is, well, look here, it's a global equity fund. The global equity tracker or the index we're trying to all beat is maybe either the MSCI World Index, which is the entire developed world. But I think a fairer one is the All Country World Index, which is all countries that are investable. Now, if you beat that, then maybe take some profits. Regardless, that is what the performance fee is. It does raise the TIC quite a bit. But if you got a hot fund manager that is consistently just always in the top quartile, maybe even the top 1% or 2%, and they're just consistently there, that's great. But they probably won't be because the data shows that these guys have peaks and valleys, and they're not normally, the guys who perform well today are not normally the guys that perform well next week. So I don't know about you, Pieter, but I haven't seen too many examples of where paying a high fee for fund management is actually worth it.
It's a zero-sum game, right? Because if we say there's the average, then half of the funds would be above the average and half of the funds would be below the average. That's just kind of like, in an efficient market, meaning there's a lot of volume and liquidity, it becomes very difficult to beat the average. So I kind of see this I like to think in pictures. If you look at back in primary school when we did athletics, if you are a matric learner that's good in athletics, like you've got provincial colors, and you are racing against the average school, person, as a kid, then you can potentially race against grade 1s and grade 3s and grade 5s. Now, obviously, you have a better chance of beating the grade 1. That's just by nature, because you're older and you're stronger and you're faster. So if you put your benchmark, the average, in this large collection of different levels of competency, then it is going to be better to beat that average. But if you have to be the best in your group, your matric group, that's going to be much tougher. So I agree with you. If the fund manager gets to set his own target, then he can pretty much put it whatever he wants it. Now, obviously, there are some regulations around what it has to be within. But like you said, if we look at the average, a lot of funds are, just to be clear, rubbish. If we look at the general kind of statistics, and I'm referring now to the SPIVA scorecards for the past 10 years, where we compare active versus passively managed funds, in South Africa, 60% of active managers have underperformed their passive counterparts. In the US of A, that is 85%, Australia 83%, Europe 92% in the past 10 years. So that already tells us, if we just compare the active fund managers against the passive low-cost benchmarks, the vast majority of them fails to beat it on statistics. That doesn't mean that active fund managers will always underperform. There are ones that are doing very well. But I agree, if you're going to pay yourself extra to beat an index, which is basically your job, all right? If you're active fund manager, you have to beat the index. So now you want to pay yourself extra for doing your job. I don't agree with that. Now, yes, if in the very rare instance where there is a performance fee and they have outperformed by a very vast amount, that justifies the higher fee, because at the end of the day, we're looking always at returns after all of the fees. And if the higher fee does result in a higher performance after a long period, not 1 year, not 3 years, a long period, 5+ years, then fine, well done, kudos to you. But I think in the financial industry, unfortunately, sometimes it's difficult to always understand what is meant by outperformance and what we actually need to benchmark returns against. And this is very important because it's oftentimes, especially with performance fees, it's difficult to quantify, it's difficult to understand, it's difficult to really know when are we paying this fee and how much are we paying it. And I think there's a reason why it's being phased out. If you look at a relatively new investment vehicle that entered into the market, tax-free savings account, there's no performance fees allowed in those investment vehicles because of the very nature that it tends to be opaque and expensive. And every percentage of fee that we pay extra is a percentage of fee that we are not benefiting from in returns, not only today, but far into the future, and compounded growth on that fee that we lose out on. So yes, there still exist some funds with performance fees, and some of them are doing very well. Again, credit where credit is due, but we have to be very careful to really understand what are we trying to compete against, and is that a fair benchmark to measure performance and to justify costs.
Yeah. No, I agree completely. And the last point on performance fees is that if, for example, it is peer group average that they are benchmarking performance against, they could outperform peer group average during a market crash. So now if you're in a 100% equity portfolio, maybe it is the last 1 year return or last 3 year return is in negative territory because there's been a market crash, like a proper bear market. But so let's just say over the last 3 or 5 years, its average return is negative 3%. And the category average is negative 6% or negative 5%. They've outperformed. They can take profits. Yeah. And so it works both ways. It cuts both ways. Some of the companies I know of have put in kind of guardrails where they don't allow that to happen, but it's a free-for-all game. The last thing I want to mention on just normal fees is hedge funds. And so you might find hedge funds, their TICs are high. Some of the hedge funds I've seen, it's 6% a year, 5% a year, 4% a year. Hedge funds are a bit different in the sense that they have to buy insurance on their policies. And what I mean by that is they pay premiums on maybe some short positions where they short the market. And if anyone's interested in what shorting is, let us know. We can discuss it in a future episode. You can just leave it in the comments below. And then on top of that, they might be doing some other sorts of exotic structures within their investments. Now, once this is worth reminding you that if you see a TIC on a fund fact sheet for a hedge fund and it says 6% or 5%, you might say, well, that's too high, it's rubbish, don't invest in this. Just first look at the performance, because the hedge fund will generally not be correlated to a normal investment fund. It will kind of provide diversification for you in your portfolio. So if you do see it's a high TIC, but then you see the returns are very good, know that the returns are published net of those fees already. So yes, those guys maybe spent a lot of money producing those returns, but it's kind of the insurance you have in your portfolio to add some diversification. My last point on this, and then afterwards, Pieter, you can maybe just finish up and let me know if you have anything else to add. Just a real case study. We have a lot of clients coming to us who've listened to the podcasts and read the finance books that are out there for the public. And these are mostly US-based media publications. And they'll come to us and say, we're only going to invest in ETFs. So I'm like, okay, cool. Why? And then we find out and we say, okay, great. You invest in ETFs, that's fine. But in South Africa, we have collective investments or unit trusts. In the US, they call it mutual funds. Now, what I have found is that on some of the investment platforms that we utilize, which are very low cost, very efficient, a client will have a tax-free savings account, for example, and every month contribute 3,000 Rand towards this tax-free savings account. And it will be invested in a global ETF, a global tracker, a passive fund, low cost. But the cost overall for that portfolio will be quite a bit higher than if they invested in the unit trust version of that same tracker fund. The reason is because Pieter said earlier on, every time you buy into an ETF, there's brokerage fees because it's trading. It's like buying shares. And so we have found that with clients, and we've had to explain that and then say, so you've heard online, or you've read online, you've heard on podcasts, ETF, but it doesn't always translate. So if there's a unit trust that's lower cost, it's because there's kind of cross-subsidization of costs within that product. It's a collective investment, so everyone's paying their way in some way, shape, or form. Whereas an ETF, you're the only holder of that one ETF. You have a contract, you bought it, it's like a share. And so that's just my kind of parting note, is that we consume the US and the UK media, but it's not always applicable to us in South Africa. That's why it's good to drill down into your investments, look at the costs, and then, you can always reach out. You can put in the comments even. If you come across a fee, you can ask us, is this high, is this low? Just give us your thoughts on fees. Maybe give us some of your stories that you've encountered when you've gone through your own finances, so other people can learn from it as well. Pieter, closing thoughts?
Yeah, on just touching on the ETFs. So what I've also found was on brokerage platforms, I mentioned earlier the buy or sell prices. So the bid offer spread, that is oftentimes a hidden cost that we don't see, because if you, for example, you can buy a fund for 100 Rand and you can potentially sell it for 95 Rand. Then essentially we've got a 5 Rand difference, which is, let's say it's rounded up 5% spread actually, that when you buy or sell, which means it's a hidden cost that we don't always take into account. So that is applicable on ETFs, especially on the brokerage platforms. And we see it if it's a big ETF, like a massive one that has a lot of volume and trading volume, it's usually a very small spread. But if it's a new type of, and you know how it is, every time there's a new market hype, they develop new ETFs, because this ETF tracks these 7 funds or these 10 funds. There's new tech one of this AI trend that the fund managers create. Just be careful, because if it's a new newish type of ETF and there's not a lot of people buying and selling into it, the bid-offer spread can be quite expensive. And you're not going to see that on any statements. It's not going to show in an EIC or anything like that if you buy ETFs. So when you do buy and invest in ETFs, just always note that when we compare that with an index fund, the TIC versus the TIC is not necessarily the full picture there. We need to think about the platform we're using, and do they also then charge an additional brokerage cost that on top of the TIC would be taken into account. And as you say, oftentimes when we run quotations for the same index, the index fund and the ETF version tracking the same index, the index fund, even with a higher TIC, sometimes work out more cost effectively because we don't have to pay and that brokerage cost every time we buy and sell. So just take that in mind. And to close off, kind of the ranges that we can expect on fund level investment management fees for very expensive, like actively managed funds. I've seen those go like upwards of 2.5%. I would say anything above 1.5% is quite expensive. They really have to justify that fee with after fee returns. And on passively managed funds in South Africa, the lowest I've seen was 0.15%, which is now typically like a very large fund that has existed for many years. And if we go abroad into the US of A, you get ETFs of 0.03%. You know, that's like dirt cheap. It's almost for free. So it's a bigger market. So that's why the fees are lower that side. Keeping that in mind, we can't compare our local funds with offshore funds on a fee level because we have a smaller market and funds tend to be more expensive just because there's high overheads that needs to be covered and there's not so many investors in South Africa as in the US. So what is most important to close off is just understanding this level of fees that you could pay. Remember, it forms part of other fees as well, advice fee, admin fee, and the other fee, a part of the effective annual cost. And in the next 2 episodes, we are going to dig deeper into those other 2 types of fees. So make sure to stay tuned for that. And then at the end, we're going to wrap everything up and give you a nice case study, myth busting episode on what we've seen in the market. So if this is the first time you've joined the podcast, welcome. Remember to subscribe and to stay tuned for the next episode. Looking forward to see you there.
See you there. Thanks, guys.
All right. Cheers. My ears are getting hot in the...
Yo.
Look how red my ears
are. Your ears are red.
I need to put in an aircon in here.
Is it hot there?
In my ear muffins. Little ice cubes in here.
Ice cubes.
They do. Yes. I'm probably going to shock myself.
Cool. That was good. Oh, my neck. Okay.
How long was it?
Okay. No one wants to listen to us for 3 hours, Pieter, but wants to listen to Elon Musk for 3 hours. So.
Not yet, Brian. Not yet.
My clients have to listen to me for 2 hours sometimes, and they pay me, but that's a different story.